may have been a bad print in Procter & Gamble.
This is very much 1987.
Biggest single widening day since Lehman.
There was panic selling on the way down, and all of a sudden it just stopped.
May 6, 2010, 2:42 p.m. The U.S. stock market seized. In less than 5 minutes, the Dow Jones Industrial Average plunged nearly 600 points, then bounced almost as fast. $1 trillion in market value evaporated only to reappear hours later. The mystery spread. What caused it? Behind the chaos, investigators later traced the faintest trail to a solitary trader working from his bedroom in West London. His name, Navinder Singh Sarao. This is the untold story of how one man's obsession with the order book, his code and a technique called spoofing, collided with an entire financial system, revealing how fragile modern markets really are. Navinder Singh Sarao was born on November 14, 1978, in Hounslow, West London. Growing up in a modest family, he kept to himself. Those who knew him say he displayed an early fascination with numbers and pattern recognition. He later attended Brunel University, where he studied a course in computing and business, but what others described as social limitations would later be recognized as part of an autism spectrum diagnosis, Asperger-ASS. After graduation, Sarao did not leap into the glamour of trading floors. Instead, he quietly took a back-office job with a small bank. Then, in 2002, joined a proprietary trading firm called Futex in Woking, Surrey. At Futex, he was one among many junior traders, but his performance stood out. Colleagues say he often sat in a hoodie, focused on his screens, and quietly outperformed his peers. By 2008, the financial world was reeling from crisis, and Sarao decided he needed freedom. He left the firm, rented a modest flat, and built his own trading desk at home. His ambition was unusual. He didn't just want to trade better, he wanted to outthink the market, the trading desk years, and the order book obsession. Working from his Hounslow home, Sarao acquired a remote trading seat on the Chicago Mercantile Exchange, CME, to trade the E-mini S&P 500 futures contracts from London. He fell in love with the order book, the digital ledger behind every trade. This was not simply buying low and selling high. He studied the depth of market, DOM data, where buy orders stacked up, where sell orders were thin, how algorithms sensed momentum. He soon developed a reputation among his firm's colleagues. He would place large trades, often taking big swings, sometimes winning big, occasionally losing heavily. He wanted the limit increased. He needed bigger size to outthink the system, but his bosses became uneasy. Trading limits were reduced. They said it was risk control. Sarao felt it was a ceiling on his ambition. He quieted his frustration and moved fully independent. He set up his own company, Nav Sarao Futures Limited, registered in London. He rented a modest semi-detached house, multiple monitors blinking, algorithmic code running late into the night. He paid programmers, asked for software tweaks, the kind of automation most independent day traders never considered. He was not just trading, he was engineering, building the spoofing technique and code. Sarao's unique approach relied on layering and spoofing orders. In the simplest terms, he would place large visible orders at multiple price points, sell orders far above current ask or buy orders far below current bid, creating the illusion of strong supply or demand. Before execution, he would cancel them and place real orders on the opposite side to profit from the shift. Here's how it worked technically. Imagine the order book in the E-mini S&P contract shows 500 lots offered at $1,200, 50, 600 lots at $1,200, 75, $500 at $1,201, each placed by Sarao's system. Behind them, he had real intent on buying at the lower price. The visible large offers signal to algorithmic traders there is heavy supply. Some algorithms begin to unwind positions or push price downward. As price drops, Sarao cancels his large offers and buys at the lower price. Later, if the market rebounds, the CFTC found that on occasions, the program modified orders thousands of times per day, and often no visible large order executed, because the goal is influence. According to their investigation, Sarao's layering technique on May 6, 2010 alone placed more than 81,000 modifications of orders and very few actual executions. Why did this matter? Because in ultra-fast markets with high-frequency trading, HFT, the visible order book is a signal. Algorithms detect imbalance, remove liquidity, or shift direction. Sarao's system exploited this signal layer. He became, in effect, a ghost manipulator, working subtly, not overtly, hiding his real intent behind many canceled orders. He earned tens of millions between 2010 and 2014 using this method. The flash crash. What happened on May 6, 2010? On that spring Thursday, global markets were already jittery. European debt fears were high. In the US, algorithmic trading dominated. Liquidity was thinner than many assumed. At 2:32 p.m. Eastern Time, a large mutual fund initiated an algorithmic sell order of about 75,000 contracts of E-mini S&P futures. As the sell orders hit, HFT algorithms reacted, liquidity disappeared, quotes widened, and the market began to tumble. The order book became unbalanced. Massive sizes on the sell side, very little on the buy side. Sarao's spoofing activity had been underway that day. According to the charging documents, between 11:17 a.m. and 1:40 p.m., he placed large layered sell orders, modified them tens of thousands of times, canceled them, and placed real buy orders at the lower price. At about 1:40 p.m., Sarao canceled all his active layered sell orders. As the market plunged, some of his real orders executed, capturing profit in the chaos. On that day alone, prosecutors estimate he earned about $879,000 from his trading. The Dow dropped roughly 600 points, then recovered about 500 points within minutes. Orders to the value of hundreds of billions moved in minutes. Thousands of quotes disappeared. Algorithms that usually exploited small inefficiencies were racing to escape the collapsing market. The crash was not caused by Sarao alone. Regulators and exchange operators concluded his trades were a factor, but not the cause. But he became the face of the event, a trader exploiting speed, code, and the invisibility of modern markets. In April 2015, the U.S. Department of Justice, DOJ, and the Commodity Futures Trading Commission, CFTC, publicly charged Sarao with 22 criminal counts, including spoofing, commodities fraud, and wire fraud. He was arrested in London on April 21, 2015. Media called him the Hound of Hounslow for his digital ghost trades from his Hounslow home. The investigation described how he moved money through offshore trusts in Nevis, Caribbean, used complex tax avoidance structures, and maintained minimal visible lifestyle while controlling major risk positions. Authorities seized $5 million in bail. They hunted assets globally. They traced trading logs, IP addresses, broker records. Finally, on November 7, 2016, he was extradited to the U.S. to face justice. Guilty plea, sanctions, and sentence. On November 9, 2016, Sarao pleaded guilty to 1 count each of wire fraud and spoofing. The CFTC simultaneously secured a consent order requiring him to pay us $12.9 million in disgorgement and a $25.7 million civil monetary penalty. The court permanently banned him from trading in registered capacity in U.S. markets. Despite a potential sentence of decades, the U.S. government recommended time served due to his cooperation, autism diagnosis, age, and the fact that he had already spent months in custody. In January 2020, the sentencing judge accepted that recommendation. Today, Sarao is back in the UK, living quietly under restrictions. He forfeited most of his trading business, his offshore accounts were frozen, and his trading reputation is irreversibly tarnished. What does this all mean? On one hand, Sarao's story is a cautionary tale, a brilliant, isolated man exploiting high-speed finance with code from his bedroom. On the other, his case exposes key vulnerabilities of modern markets: the dominance of algorithmic trading and thin liquidity in moments of stress, the illusion of human control in markets now dominated by code, how one individual, with enough size and automation, can influence price signals rather than manual orders. After the flash crash, exchanges installed circuit breakers, expanded monitoring of algorithmic behavior, and regulatory focus on spoofing increased. But millions still trade in milliseconds, with blind spots. Regulators publicly said Sarao did not cause the crash alone, but the fact they charged him shows they believed his actions contributed materially. The order book has become a battleground. Speed, automation, and stealth replace floor traders. Sarao figured this out early, but he used it for profit rather than reform. Navinder Singh Sarao didn't invent the system. He simply found a way to exploit it. The lesson isn't just about one man's greed. It's about a system built for billions, running on algorithms you cannot see and speed you cannot follow. For you, the viewer, the world of finance is no longer a desk and a phone. It's servers, software, signals, and sometimes the noise hides what matters. If you love stories of money, power, and ambition, subscribe to Aznar Wealth, where every fortune has a story, and every story inspires the next one. Hit the bell, because the next wave of disruption, it's already trading in milliseconds.